When you look at the markets today, it can feel like just a storm of chaos, right? But what if I told you it's not random at all? What if there's a single logical chain reaction driving pretty much everything we see? That's what we're going to do right now. We're going to find that first domino and then watch it topple all the rest.
So, to really get a grip on today's economy, we've got to find just one single number, a price that's acting as the first domino, setting the tone for everything from stocks and bonds all the way to the US dollar. Let's find it, and then we'll trace its impact through the entire system.
Okay, so before we can find that number, we first have to understand the market's current, let's call it an operating system. It's what the pros call a macro regime, and right now we are in a regime where one single force, and that's energy, is calling all the shots and basically defining the rules of the game for every other asset out there. All right, so let's get started. It's time to identify that macro trigger, the very first domino in the chain. And here it is, $103.98. That is the single most important number for global markets today. It's the price of 1 barrel of Brent crude oil, the global benchmark. This price, right here, is the starting point for literally everything we're about to unpack.
Now, that price, it doesn't exist in a vacuum, of course. As you can see from this table, at nearly $104, we are sitting firmly in the current volatile regime. Now, it's not a crisis, but it shows a market that is definitely on edge because of geopolitical risk. If we drop below $95, things calm down. But a move above 110, that could trigger a serious inflation shock. I mean, we are literally balanced on a knife's edge here.
Okay, so how exactly does the price of 1 barrel of oil ripple out and affect, well, everything else? Let's trace the financial chain reaction step by step and find out. I want you to think of this slide as our roadmap for the next few minutes. It lays out the entire macro transmission chain. Just notice the flow. It all kicks off with oil. That hits inflation, which in turn drives bond yields. Higher yields make the US dollar stronger, and a strong dollar, that creates tighter financial conditions around the world, which finally puts the squeeze on risk assets like stocks. Let's walk through it, one domino at a time. So, what's the second domino to fall? That would be US bond yields. See, when oil prices stay this high for a while, it starts to fuel fears of persistent inflation. And in response, the bond market starts demanding higher yields. Basically, they're betting the Fed will have to keep interest rates higher for longer to fight off that inflation. And that brings us to our second key number, 4.33%. That's the current yield on the benchmark 10-year U.S. Treasury note, and it's a direct reflection of the market pricing in that higher for longer interest rate story. So why do we care so much about that 4.33% number? Well, this right here shows you the key levels that traders are watching like a hawk. Right now, we're in that green baseline zone, which is okay. But if yields start to push into that yellow zone above 4.5%, that puts serious pressure on the stock market. And a move toward 4.8%, that signals a major risk-off event where investors just start running for the exits. All right, let's keep following the chain. What happens when U.S. bond yields look this good? It's simple, really. Global money just floods into the U.S. to capture those higher returns. All of that demand for dollars, well, it leads directly to our third domino, a stronger U.S. dollar. So this chart here tracks the U.S. dollar index. You'll hear people call it the DXY. It measures the dollar against a whole basket of other major currencies. And at 99.7, you can see we're right at the very top of that neutral range. And the implication here, it's huge. A sustained move above 100 signals tight financial conditions, and that acts like a brake on the entire global economy. So when you put it all together, high oil, high yields, a super strong dollar, you get a really, really challenging environment for investors. And if you want to see its effect in real time, we can look at the assets that are most sensitive to this kind of pressure, things like cryptocurrencies. Bitcoin is actually a fantastic live barometer for risk sentiment. At around $69,000, it's just hanging out in this fragile neutral zone. There's no panic, but there's no real confidence either. A solid move above 70,000 would tell us investors are feeling bold again, but a drop below 67,000, that's a huge warning sign that liquidity is starting to dry up. And all of this, it brings us to the final domino in our chain, the stock market. Every single one of these factors we've talked about, inflation fears, higher borrowing costs, tighter global money, they all combine to create a really tough headwind for stocks. And this quote right here, it just sums it all up perfectly. Markets are trading macro plus geopolitics, not fundamentals. What that means is, right now, how well an individual company is doing, its earnings, its growth, it just doesn't matter as much as these big top-down forces that we've been tracing.
And if you need proof, look no further. The VIX index is at 26. People call it the market's fear gauge for a reason, and any reading above 20 basically confirms that investors are nervous, they're on edge, and super sensitive to headlines. Okay, we have traced the entire chain reaction from that first domino, oil, all the way to stocks. So now, let's pull it all together into one simple, actionable dashboard.
Think of this as your cheat sheet for the current market. These are the critical breakpoints to watch. If oil breaks $110, or if yields cross 4.5%, or the dollar index pushes past 100, or Bitcoin falls below 67,000, those are your clues that the market is probably going to reprice lower. If you keep an eye on these far numbers, you'll have a really good sense of what's driving the whole show.
So after all that, what's the big takeaway? What's the bottom line for trying to navigate this whole environment? The most important thing to get is this. The market isn't necessarily in a crisis, but it is definitely operating under a new set of rules. It's pricing in a constant oil premium thanks to geopolitics, which just means that high volatility is the new normal. And as long as Brent crude stays above that $100 mark, the entire domino effect we've mapped out here is going to stay in play. So if you're going to remember just two things from all of this, let it be these: macro dominates and headlines drive. That's really the essence of today's market.
And that, well, that leaves us with one final thought. The system right now is stable, but it is incredibly sensitive. We know the first domino is the price of oil. So the real question for all of us is, what headline is going to be the one to finally tip it over?